Okay, welcome to the Hurley Investments Financial Services Commentary for Tuesday, September 18th of 2018. My name is Kevin Hurley. I've got, looks like 17 in our audience today, and I'm going to go ahead and ask some questions. In fact, I am outright worried in what I see in our market. And more so, I'm worried at the lack of understanding of where we should be going. Now, I can't time a market downturn, tops to tops, bombs to bombs, than anyone else. In fact, I should ask, anyone here today able to time tops of markets and bottoms of markets and know exactly when to buy and sell stock, get in and out, buy or sell protection? Lance, I love you. Lance typed in there. Of course not. I had a couple lots of laughs here. All righty. I'm worried because I can't understand why people, I'm going to say the retail investor, why can't anyone seem to understand the current risk in the market and what are the signals? I've discussed yield curve in the past. And I'm just going to go ahead and I'm going to bring this chart in here. An inverted yield curve tells us that investors believe the Federal Reserve is going to be dramatically cutting interest rates. Typically, the Federal Reserve has to dramatically cut interest rates during a recession. Therefore, an inverted yield curve is often a sign that the economy is or is headed for a recession. So with that said, and we're super close to an inverted yield curve right now, you can see the chart there, what inverted yield curve looks like, and then the prediction of what they are for recessions. So let me go ahead and ask you a question. Have we been in a recession since 2008? Maud says no. Anyone else? Have we been in a recession since 2008? Gary, David, what do you think? A couple question marks from Mary. So it's interesting because I can go and I can bring in charts of, in fact, maybe that'd be a good thing to kind of look into right now. What if I brought in a chart? Let's see. Chart of S&P 500 yearly earnings growth. A recession is not 20%. A recession is two negative GDP earnings quarters in a row. In fact, why don't we go to that? Let's go through and let's find out exactly what a recession is. That's perfect because that's a good understanding that'll be helpful. In economics, a recession is a business cycle contraction which results in a general slowdown in economic activity. Macro numbers such as GDP, investment spending, I've always understood a recession to be two negative or two GOP quarters that are slowing. So two negative growth, GDP growth quarters are what I would say. And I'm going to bring in an earnings, see if I can't bring an earnings chart. because this is where we might have a little play on words. No, I don't want to sign in, but that's gonna. But I guess I can use this right here. Taking a look at 2014 down through 2016, what do you see? Or if we looked at it, two thousand ten to 2009 to 2010 to 2011 to 14 to 15. Are those earnings growth quarter after quarter? Gary just typed in a comment that said, people often say recessions when GDP growth rate is negative for 2 consecutive quarters. Thank you, Gary. I mean, I'm sorry. I'm looking at different periods of time where we don't see the growth in the S&P 500. In fact, I can go so far as to say we've been in recessions over the last 8 years, except for the fact that government spending, fiscal stimulus, and GDP recalculations and inputs changed have avoided the typical, and I should go ahead and say typical, GDP recessions. Am I crazy? Am I not understanding it? So fudging the numbers, all governments want to do this. Yeah, in fact, I'm going to do a couple other comments, and I do need to give some credit to Michael Verdon and the research that he brought to me today. We're going to have probably on Thursday, we're going to create a podcast that we're going to send out. But let's talk about, in fact, if I can go ahead and put that in there, because that's a great way to say it. From, I'm just going to say a comment. So fudging the numbers, all governments want to do this. And agreed. Unfortunately, I'm going to agree. Now, I'm going to start with the U.S. Anyone know what our deficit is going to be this year? I have 1 trillion. Any other numbers? Any other guesses? Gary, Lance, normally you guys are going to be ones that kind of focus on the numbers I've noticed over time. There you go. Yeah, I agree. I thought it was 1.3 trillion. When it's government spending and the new military spending that we're willing to do, which I guess to a certain degree, I understand it. So let's put this into perspective. This is hopefully going to spur 1 more percent of GDP growth, right? And to do that, it's going to equal about 200 billion more, how would I say it? Taxable dollars or growth or income, right? Which means taxes at roughly 20% equal how much more revenue for the government? Simple math. 20 times 2, cut off a 0. 40 billion, right? So working some simple numbers, is our government spending 1.3 trillion to have us make an extra 200 billion so they can make an extra 40 billion? I'm not sure that the means justify the end. Why are we spending 1.3 trillion more that might make 200 more billion taxable dollars so the government makes an extra 40 billion? Kick the can down the road. You know what? 2 of you just said that exactly the same time. Mary and Maud, the ladies are on it today. It is. It really is kicking the can down the road. If I was to change this just a little bit, rising interest rates does 2 things. Dang, I can't type. Sorry. I don't know if it's 21 or 23. I think it's 23 trillion, right? Last year, with an extra 1% interest rate in long term, or actually it's short term, I'm sorry. Well, in bonds, right? Equals 230 billion in interest payments alone. And I might be off on that by a little bit, but I don't think so. I've got to work on my zeros, but I'm pretty sure that's exactly right. Because 10% is 2.3 trillion and 1% is 230 billion. So that should be correct. Ida, let me answer that question here in just a minute. Great question, though. But what does also rising interest rates do to the U.S. economy? Slows it down. I'll agree with that. Slows it down and slows down the money flows. Let's talk money flows. What is the Fed doing to their budget right now? What is the Fed doing to their budget? Reverse quantitative easing. Kind of. Could I say they're contracting? Ooh, there we go. Bingo. They are shrinking the money supply. So, if India wants to grow at 5% GDP, they need 5% more US dollars to do so. Because the world's reserve currency, all commodities, and commodities are considered the necessary food, materials, growth, right? Commodities are traded in US dollars. I tried to show a couple weeks ago how the rest of the world is on fire. The rest of the world is getting their butts handed to them. Emerging markets are getting crushed. And I'm going to tell you it's in direct relation to the fact that there's a shrinking money supply of US dollars. To hear Russia's selling off some of its currencies, its quote unquote treasuries, China selling off its US dollars, in all essence, we think, oh, that's bad. They're our number one. All they're trying to do is infuse liquidity into a global economy that has the key player, the US, that's trying to shrink those dollars. If India wants to increase all their infrastructure and all the steel and cement and blah, 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 they need a huge supply of US dollars. When dollars become sparse, it increases in the currency exchange rates. It's a self-fulfilling prophecy that obviously emerging markets are going to get crushed. Turkey, China, Brazil, boy, I can name quite a few. All look absolutely horrible this year. So I guess what I'm trying to say, the Fed has crushed global growth to to balance. It's ridiculous. It's obviously not spelled right. Right now. Other governments to prop up financial markets, and this isn't just the banking system, their trading markets and so forth. In order to prop up their markets, they have gone to buying the equities outright, which in essence pushes the can down the road again, right? God, I think you want to look at Japan. Own 80% of the float in their markets. Now it's funny because they talk about inflation, right? And Ma just brought that up. And we seem to be in a deflationary market. Question was asked, what influence does stock buybacks artificially color rosy earnings? They do. When you have less shares that are float, you get a better earnings per share. That's why it's so important and why people are so worried about the revenue number, right? The bottom line. Are they growing revenue or are they growing earnings per share? The bottom line. If they're not growing revenue, they can grow earnings per share artificially. It's not company growth, it's stock buybacks. Recessions are nothing more than a Fed induced credit cycle. That's all. That's it. That's all recessions are. And it's directly related to money flows. Well, Kevin, I thought it was growth. It is. And growth is the byproduct of money flow. The more money flowing, the more growth occurs. Who is always 100% of the time the last person to the stock market growth party? Ooh, wow. 4 of you all at the same time. Retail investor, right? 5 of you now. The retail investor is always the last person to the party. Always. The mean reverts back to parity, right? I'm going to say in my research over the last 7 months, every indicator points to I'm going to say this without trying to be Mr. Scary, right? Points to recession, market top, end of cycle. And I wanted to show you some of what I have seen that justifies this. In all honesty, I've had people that have been pissed off that I haven't put money to work. And I can't put my own money to work. I've just sold a house. And I'll be honest, I have a really, really hard time with an extra $100,000 finding a position that tells me I should be into it. There are very few stock positions that on evaluation means say, hey, now's the time to get in. This is from RBC Capital Markets, Consumer Confidence. And it's a trend line. The gray areas are the recessions. This is the biggest, longest since 1964, I believe. The longest upward trend in history since the consumer confidence number is being followed. When consumer confidence is at its highest, what happens? We hit recessions and huge market drops. Some of those lines are skinnier lines. But if you want to see what a recession or a quick pullback would look like in our markets, if the U.S. can't hit its numbers, if the U.S. doesn't understand that we've got to be perfect in our earnings, mathematically, it's going to look like that and worse. Mathematically, you'll see an index look like a stock. 218.62 minus today's close at 160.30 is a drop of $58 divided by 218.62. There's a 26.67% drop in Facebook. Mathematically, with the same kind of miss, with expectations so high, the S&P 500 should follow this, the Dow should follow this, the NASDAQ should be worse. Consumer confidence, it's only a trend line. Longest run in history since it was recorded. Conference Board Consumer Index. Notice how you see the regression line on the GDP. The average GDP slowing 1977 through 2017. Currently in 2018. Again, historical highs. Let's go to small business. Consumer confidence marrying the NFIB optimism index. Almost at all-time highs again. For both. And of course, I'm going to use the Michigan sentiment. People again. I've lost a little bit of money from some clientele that just saying, hey, if you have extra cash, I'm ready to do it myself. I've got neighbors that also sold a home for $100,000 of profit. Threw into Facebook. Not at 19,000, at 16,000. Not Facebook, excuse me, Bitcoin. The Bitcoin rage. Kevin, what do you think? It's kind of dumber than dirt to do. Not a really good thing that you should be doing. Oh, come on. It's going to go up to $50,000. Yeah, trading at $6,326.98. 4 Bitcoins purchased at $16,000 a pop. You know what, Kevin? I'm going to go find something that's going to put it into anything other than keeping me in a little bit of cash. All right. Have at it. It's yours to do what you want to do. It's always your money. I'm not going to tell people what they should do with their money, but I will advise them that it seems awfully foolish if I can be at a 5.67% return on a 6.63%, only using half your money at risk. Just let me do what I do. We must be near a top, Mod. And can that top be extended through more fiscal stimulus, through quantitative easing, through the Fed buying, or the government's now buying stock markets? And boy, I wish I could show you the profit. I saw it on CNBC, I believe. Maybe it was Bloomberg. But the government loaned $634 billion, got paid back $712 billion, loaned it out to companies. What if the government starts to backstop our market and buy every failed company? Yeah, we could go even farther. We could be pushed even farther on our stock market. But valuation metrics, there are very few stocks that make any sense. I don't see, know, or understand how companies are going to be able to even come close to next year's comps, because 1/3 of their current growth is not organic growth, but tax savings, and companies are not building for the future, but they are buying back stock. Our pullback, our correction, our having to reckon the debt, paying our dues, if you back everything out of the S&P, it would put us back down to a 20% drop, at least at 2,400. But a correction filtering out the money and so forth could put us much closer to 1265. It has been a hard year. A hard year in finding low valuation, potential, and that's not the word I'm looking for. I'm looking for it's been a hard year finding low valuation, high probability growth stocks to put new money in. It's hard. I could, plain and simply, just not give a flying flip and throw them in so I can charge them, put you into a mutual fund, an index, and say, let it ride, let it roll. That's not who I am. And for those few that decide they need to go elsewhere, it's going to hurt quickly. And I do hope some of those people come back. But the problem is, last time I had that happen, they came back with only a third of what they left with. And for all intents and purposes, as much as it pisses me off that things aren't coming over to me, and they're learning the hard way, no one that's, I don't know, no one that's a real person. I'm not saying that right. Anyone that's worked the hard way for their money shouldn't have to go through that. You shouldn't have to. It's ridiculous. And again, another crash like 2008 will be an easy year to make a 20, 25, maybe even a 30% return. The key, nothing more than adding extra long puts as stocks crash through support levels. It's going to be even worse. Our next correction will be exasperated. I don't know how to spell that. Aspirated. That's why we have spell check, right? Exasperated by the algo, robo, computer slash stops programs currently running the liquidity in our markets. It's stupid. Where has people's common sense gone to? Why are people looking for someone else to do it for them? Why are people expecting all this continued growth when the numbers just don't add up. If you ask me where I think our markets are going this week, probably going to go lower. That's directly related to options expiration on Friday. And I don't see from our market action, if I can jump ahead a little bit, we are bullish, but approaching the overbought territory yet again. We are bullish on the S&P. We had our little drop down, less than 3%. But I haven't seen the selling that'll justify a short covering rally on Friday. I just haven't seen it. Our highs are 916. I'm not going to see the short selling, what leads up to short selling, which will cause that pop on an options expiration Friday. In fact, if anything, I bet it's going to look more like, if I can use a pen, it's going to be more like our April, maybe more like our June. Just thinking, not trying to predict, but I am definitely protecting myself. What else happens? Anyone know what else happens in September? Why is September historically the lowest or the worst month in the stock market? Mutual funds rebalancing. You got it. Mutual funds are coming to their end of their fiscal year. They got to pull out the losers. Losers will be exasperated or look worse going into the end of September. Got to cash in a couple winners to offset the losers that they're getting rid of. Have to put some new stuff in that looks like it's a winner. And then in October, you run back into the ones that have been on the fence. They seem to get out that first couple weeks and put their new opportunities in as well. It really looks ugly. And again, no, I'm not predicting a top or a bottom, but I would still expect a 2% end of the month, September. Haven't changed. Earnings, AutoZone killed it. Unbelievable. An $18.54 earnings on an expected 17.91. Only beat it by 35 cents or something like that. 63 cents, excuse me. Red Hat on Wednesday, Darden Restaurants, Micron on Thursday. Nothing's really moving the market. We do have housing starts tomorrow, building permits, leading indicators, existing home sales on Thursday. Really, everything happens next week. Next week is your heads up. Next week, you're looking at a Fed rate decision on Wednesday. Consumer confidence, Case-Shiller, FHFA housing indicators on Tuesday. Again, FOMC rate, new home sales on Wednesday. GDP, durable goods, pending home sales on Thursday. Personal income, personal spending on Friday. It's next week is going to be a week in our stock market to finish off our month. Not to mention on Friday, end of the month, it looks like maybe our sell-off starts on Friday going through next Friday, our rebalancing. I haven't seen it yet. Haven't seen the volume indicators that say rebalancing has happened yet. fact, if anything, we've got pretty darn low volume, especially compared to an April or a June. How am I looking to trade? Added long puts to everything. Disney, Ford, Visa shares. I'm not protecting long calls. What else? What else have I added to? Bank of America, pretty sure. Just trying to get out through at least the middle of October. A couple interesting articles that I've read. A lot of them are kind of next week. On Sunday, I read the article, the U.S. trade war could cause a bear market. It's kind of like saying, duh. But obviously today we blew it over. It's stupid. Stupid, stupid, stupid. I don't get it. Well, it wasn't the worst case scenario. It was only a 10%. Yeah, but it's 25% by the end of the year. Unbelievable. Pretty interesting stress test for stock markets. Conservative view, 21%, 16.5%. Realistically, 63%, backing out money and what have you. Stress test for bonds look pretty poor. Nobel Prize winner Schiller sees bad times in the stock market. I pulled this one last Friday the 14th. These are people that are smarter than me with better money and better research than I could ever do. I've shown you this before. China may use its private markets to defend against Trump's trade war offensive. This was on September 12th. I think I posted this last week as well. Kind of interesting to see how we can prolong our stock markets from a Chinese side. I did find it very interesting. There's a lot of information here. But people talk about why I put some more money into Visa and Disney. If they're both quote unquote overpriced, bad valuations. Well, Apple's not. And Visa is stretched, but I see some holes in it. But really, if you want to see what research is, this is calculating these numbers, going through and finding these numbers in Apple's balance sheet, finding out if this person even has correct numbers, going through and doing the calculations based on current price to earnings, PE ratios, future PE. Pretty interesting to see these numbers to validate it and then to calculate it as they did. There's a lot of information here, but it's all numbers. The numbers are correct. For the most part, I could pick out a couple things here, but the numbers are correct for the company with the most money out of all the companies I think that are out there. Pretty amazing. If you want to go through research, this is the research. This is the article to read. This is what Hurley Investments, registered investment advisors are going through. We're running these numbers as we're sitting at home. We're running these calculations. We're taking a look at what we have and where the growth opportunity is. These are the calculations that I run. They're much like Warren Buffett's calculations. Plenty of risk to put in here to see what's going on. But pretty amazing to run these calculations and see where some opportunities might be. And then don't like the guy, but pretty important. Jeff Bezos' daily routine, and it sets him up for success, really comes down to getting some sleep and spending the time with the family, with what matters most. So pretty interesting to read how a billionaire still isn't necessarily following the almighty dollar or putting that in front of family. So please feel free to read through. Please enjoy this. I'm going to run to questions. What questions do you guys have that if I have missed it, or that if you would like me to answer for you, that I can? Where do you see the election adding to the pile of it all? Mark, October has some issues, right? October, you have the China gold-backed oil trading currency to avoid US dollars. You have most likely the rate hike. If it doesn't come in September. And you have the start of the ugly name calling midterm elections. And then isn't it on November 14th? Isn't the 14th that are the I thought it was the 14th. First Tuesday are the midterm elections, so election day, correct. Thank you. November 6th. We find out if the government hits gridlock. And I'll be honest with you, that's I'm going to tell you that's 50-50 right now. I think that's a 50-50 chance that the Republicans hold everything and we keep moving forward, or we come to a screeching halt. So I'm not looking at the elections yet. I'm looking to see how the world reacts to China and Russia trading oil and natural gas on this new China-backed trading currency. The rate hike, I think, will be important, and it'll be interesting. It'll be interesting to see how ugly right out of the gate it gets when we start hearing the debates for midterm elections. If you asked me, the China-Russian oil-backed, how can we do some type of basket of currencies, will significantly influence the U.S. ability to have economic advantages against the rest of the world. And we've done a horrible job. We have done an absolute horrible job of taking advantage of this economic bliss we've been given. We just ran up our damn credit cards. We just said, you know what? We're living life rosy. We're going to have this for decades to come. Off we go. And we've done a horrible job of preparing for a rainy day. A horrible job preparing for a rainy day. When bite open long puts, do you go past the earnings report? Normally I do, but right now, uh, since we're kind of smack in the middle of earnings, I was really just buying to get through the first week of October. So that's where I am buying my long puts. There are some that are out till the fourth week of October because they were a good price. But normally I'm trying to protect through my earnings and about 4 weeks before the next one. Now when I'm protecting for the middle of the cycle, when things are kind of flat, this is the only quarter that I'm protecting usually for market movements. What I've put on is really out to October monthlies. I've got a couple that are October 1st week and some that are out to October 4th week. Like Baidu, I'm going to protect that a little bit longer term. So it's kind of a feel right now. And do I monitor the DXY on picking sectors to trade? I'm not a big fan of saying you diversify or you follow the money flows from sector to sector to sector. They don't happen consistently enough for me to follow. I do think you can protect portfolios with long puts on indexes, but kind of like Warren Buffett, you invest in an index, you invest in a mutual fund when you're too stupid, quote unquote, to do anything else. And I know that's not fair to say. Well, I guess it is fair to say from him. But people invest in index funds, they invest in mutual funds when you don't know how to invest, when you can't calculate what should be a good value. And remember, good values are not based on time. Ford's been a good value for a hell of a long time. And it has done nothing but suck rocks. Value is not time-based. The beauty of being a Warren Buffett with billions of dollars, he doesn't have to worry about it. For the rest of us, we need some of these to hit before we retire, before we need that money. So plain and simple, value-based investing isn't based on time. It's finding good low-price stocks that could really go higher. And it's funny, Mark just says, hi, I agree. Before I could go back and touch 385 or what, the 323 lows at 2008, or was it at 150? I think it was at 150. Yeah, Ford could go down lower. And it could go down lower for doing all the right things, for keeping its dividend, for moving away from its lower margin vehicles or zero margin vehicles and moving to where its profits at, and that's the trucks. They've done a really good job of streamlining their expenses and cutting all the fat off. And it's kind of weird because, the market apparently doesn't like it. So for all intents and purposes, kind of a pisser for Ford. It's restructuring again and doing everything right that it got penalized for by not taking the bailouts. And I want to tell you, hopefully I'm not married to the stock, but Ford is a good value stock. It's even a better value if you wanted to go on its metric numbers than Apple is right now, because Apple's kind of gone higher. So pretty interesting. Any other questions you guys have that I can answer for you? I hope this gives you a heads up on what I'm seeing and what I'm looking at. I hope this gives you a heads up on my level of integrity, that just because I have your money, I don't feel like I've got to go throw you into something so I can start to charge you. I will let you know. New money might sit a little bit, maybe even all the way out to November, till I feel comfortable getting you into something. If you're looking for a stockbroker that just wants to charge you, and if you're looking to hold it over my head that, hey, you know what, you should have put me in something, again, to get a 5.6% with not even using a full 50% of your money when the market was at 6.63, to miss the S&P 500 by 1%, but to only have half your money at risk, figure it out. Figure it out. If that's not going to be important to you, if it's all about the returns, for hell's sakes, go to Vegas. Good luck on your returns. Go treat the stock market like a slot machine. That's not what we do at Hurley Investments. It's not the way we are interested in treating people. Or in all honesty, I don't want to take the risk of blowing up someone's retirement. I've seen the damage that can do. And because of that, I'd rather be a little more careful with my clientele's money. Mark, so you're just protecting your positions with puts based on your current open positions? I am. Just puts, but I have no put protection on any in the money covered calls, and no put protection on leap long call positions. Those have their protection kind of built into them. It's a leap long call. I don't feel like I have to have puts on those just yet. I may change my mind by tomorrow, but I think that's the way I'm running portfolios right now. So no new trade puts on overall market hedge. Mark, not yet. Again, as you're looking at our stock market and our charts, what would you use as your trigger? 2916, the highs, breaking 1900. Are you going to give it a play of 25 basis points down to 2875? Would you use 2850, which is only 55 points down right now in the 50-day simple moving average? Are you okay spending some money now out of the money, maybe making it cheap and going down to the 2850 for a drop? Yes, but I usually am looking for an indicator. I know what should happen, but Mark, I'm not going to outguess and start to throw hedge protection on portfolios using indexes just now. I wouldn't use long puts on indexes to hedge protection just yet, but that's not a bad idea. There's nothing wrong with looking at doing that. In fact, that might be a really good way to get ahead of the curve, to be honest with you. Any other questions you guys have? If not, I want to appreciate you being here today. Hopefully I don't sound too frustrated, because I'll be honest with you, I am a little frustrated. I'm a little frustrated with the retail investor. It really worries me that people don't learn. And because of that, it's unfortunate that they call the retail investor dumb money. But if you keep making the same mistakes over and over again, it's interesting that you're not ever going to see a different result. Guys, have a wonderful evening. I appreciate you letting me vent a little bit on you. I will have this posted most likely by tomorrow morning. For those that are clients of mine, you will see this as a link on an email, just so I can help everyone understand, again, what we're looking at, what we're seeing, and why we're worried about it. Please, everyone, have a great evening. I appreciate you being here, and I look forward to seeing you again next week. Good night, everyone.